Social Security Made Easy is a production of Retirement Workshop. The purpose is to improve your understanding of how Social Security works, so you can make more informed decisions when you select your benefit options and better manage your taxes. This short video will explain how Social Security benefits are taxed. At the end of the video, we will offer you the opportunity to obtain our detailed report entitled Making Social Security Easy. The material is designed to provide general information on the subject. It's not intended to provide specific legal or tax advice and cannot be used to avoid tax penalties or to promote, market, or recommend any tax plan or arrangement. Please note that Retirement Workshop representatives or employees do not give tax or legal advice. You're encouraged to consult your tax advisor or attorney concerning your own situation. Clients should also seek the guidance from the Social Security Administration regarding their particular situation. Congress imposed taxes on up to 50% of Social Security benefits in 1983 if provisional income was over $25,000 as a single taxpayer or $32,000 for joint taxpayers. In 1993, additional taxes were imposed for up to 85% of Social Security benefits if provisional income was over $34,000 as a single taxpayer or $44,000 for a joint taxpayer. To this date, these income thresholds have never been adjusted for inflation. Provisional income is your annual adjusted gross income plus 1/2 your total annual Social Security benefit plus all tax-exempt interest. Tax-exempt interest is interest earned from municipal bond investments. The total is provisional income. If your provisional income is calculated to be over any of these annual thresholds, then some percentage of your Social Security benefit will be taxable at your marginal tax bracket for that year. If you look closely at your 1040 income tax form, you will see your adjusted gross income is listed on line 37, located at the bottom of the first page. Line 8B is where you list your tax-exempt interest. Line 20A is where you list your total Social Security benefit that you've received, and 20B, the Social Security amount that's taxable. If your provisional income is over one of these thresholds amount, the lesser of 50 or 85% of either your total Social Security benefit or the excess amount your provisional income exceeds the threshold is added to gross income for tax purposes in that tax year. The net effect is some of your Social Security is taxable. The income taxes you pay are credited back to the Social Security Trust Fund. Let's look at an example of how the calculation is done. We'll assume we have a married couple with an adjusted gross income for the year of $40,000. Their total Social Security benefit during the same tax year was $18,000, and they also had $1,000 of tax-exempt interest. Provisional income is a total of their $40,000 AGI plus 1/2 their Social Security plus tax-exempt interest for a total of $50,000. The 85% threshold for joint taxpayers is $44,000. If we subtract this from their provisional income of $50,000, the excess is $6,000. 85% of this excess is $5,100. Add this to 50% of the difference between the lower threshold of $32,000 and the higher threshold of $44,000, which is $6,000 plus $5,100. Compare the total, or $11,100, to 85% of their total Social Security benefit for the year, which is $15,300. The lesser amount of $11,100 is added to the taxable income for the year and then taxed at their highest marginal income tax bracket. Let's just consider if the earnings were $2,000 higher for the year. Now this couple's provisional income is calculated to be $52,000. Subtracting the 85% threshold of $44,000 and calculating the excess at $8,000. 85% of this excess is $6,800. If we add back the 50% difference in the two thresholds amounts of $6,000, the total is $12,800. 85% of total Social Security is still $15,300, which is higher. So an additional $12,800 is included in taxable income for the year because it's the lesser amount. The point in all of this is to note that a $2,000 increase in income accounted for a $740 increase in income taxes. So, even though this couple was in a 20% marginal tax bracket, the added amount of Social Security taxes due to their crossing the threshold means their additional $2,000 income was actually taxed at a 37% effective tax rate. Here is a table detailing the Social Security thresholds for different tax filing categories of provisional income. The foregoing example is why it's important to continue to manage your taxes even in retirement. The threshold amounts have never been adjusted for inflation, so it's more likely that as your income rises to keep pace with inflation, more Social Security beneficiaries will cross the threshold and pay taxes on some of their Social Security benefits. It would be wise to consider ways to minimize your taxes in retirement, looking for ways to utilize tax advantage investment strategies to reduce taxable income. The strategic deployment of immediate annuities, master limited partnerships, Roth IRAs, and cash value life insurance may provide alternative tax-sheltered income. Remember, municipal bond interest is included when determining your provisional income, and although it may reduce your reported taxable income, it may put more of your Social Security benefit in the income tax crosshairs. If you stop working and choose to earn delayed credits to age 70, consider taking early withdrawals from your IRA to minimize the later effects of required minimum distributions, which begin at age 70 and a half. Traditional IRA assets can also be converted during the same time frame into Roth IRAs to gain more tax control. The bottom line is that you want to continue to manage your taxes throughout retirement. If you're watching this video, then you probably are a Social Security beneficiary. By selecting a strategy to maximize Social Security benefits, you will have created the foundation for a solid retirement income plan. Social Security provides an inflation-adjusted income guaranteed to last as long as you live. The next step in the planning process is to coordinate your other retirement assets, such as pensions, retirement savings, personal savings, annuities, and factor in if you intend to continue working either full or part-time. When assessing the risk in a retirement income plan, consider breaking down your specific assets and expenses into 4 categories. Divide your assets into 2 groups, those like Social Security that provide a guaranteed lifetime income, and personal assets you must continue to manage. Then divide your estimated expenses into either an essential or a discretionary category. Here's a quick summary list of assets and expenses categorized as we have suggested. Once you've completed your list, estimate the total annual amount for each category. This way, you can assess the risk to your retirement income plan. Compare your guaranteed lifetime income to your essential expenses. It has been our observation that many retirees have a substantial shortfall to cover their essential expenses with guaranteed lifetime income. This is because most of their money is held in the personal asset category. A strategy to consider is moving some of the personal assets into the guaranteed lifetime income category. An excellent investment vehicle to provide a guaranteed income for life and reduce the investment risk is the annuity. If structured properly, annuity income can provide additional lifetime income that's guaranteed to relieve the greater dependence on the investment performance of your personal assets. Now you know how the IRS taxes your Social Security benefits. This is just one of many videos Retirement Workshop created so you could become better educated about Social Security. We created this series of easy-to-digest videos so you could either go right to the area of greatest interest for you or view them all to gain a full understanding. Our objective was to provide an easy-to-use format to learn what you need to know to make an informed decision. If you'd like to have a complimentary copy of our full report about making Social Security easy, simply log on to the following website and request your copy. Thanks for joining us. We would appreciate any comments you'd care to make.